Welcome to Trading Nation. I'm Mike Santoli. One of Wall Street's most vocal bulls suggests the bottom is in following last week's sell-off. Jeff Saut of Raymond James joins us with his analysis. Jeff, great to see you. So first of all, before we get into exactly where we go from here, what's your quick read on exactly what did prompt that sell-off last week?
Well, 2 weeks ago on Tuesday, our short-term proprietary model flashed a sell signal. We wrote about it. We told people to abandon trading positions. And then you saw what happened. The following Wednesday, we had what I would term a mini crash, and it lit up a number of finger-to-wallet ratios suggesting that a bottom was in. The trading pattern today has been a multi-swinging pattern between up and down, and that's usually how bottoms are formed. Now, as to what caused it, I actually think it was the Chinese. The Chinese needed to hurt the U.S., so they sold treasuries that raised interest rates. It also put a headwind potentially for President Trump in the midterm elections. They got U.S. dollars for selling treasuries. They used those U.S. dollars to buy renminbis, their currency, and support their currency. And then the third leg of their plan was to inject the renminbi back into the Chinese economy because it was slowing and slowing noticeably.
Yeah. Now, we should say this is just your read on it. We didn't have anything official on the Chinese selling treasuries, but it would fit in with this backup in yields that we did see. So if you think that last week we got pretty oversold late in the week, as you're suggesting here, and you had the makings of a trading low, what are you going to be watching for, I guess, kind of the tenor of any rally from here to tell you that it's lasting?
Well, it's just like a heart attack patient doesn't get right up off the gurney and run the 100-yard dash. He needs to convalesce for a few days. I think the equity markets are going to do the same thing. It's not necessarily written in Sanskrit, but you may come back down and test the lows of last week. I'm really not expecting that. I think that would be a little too convenient. Or you may make a slightly lower low, which is what happened in February. We came down into a selling climax low on February 6th, had a failed throwback rally. You came down an undercut low on February 9th, and that was it. And we told people to actually buy that undercut low. So we think we're in the same kind of sequence right here. Earnings season's coming up. I think that's going to be the catalyst for the equity markets to trade back up to new all-time highs.
So the bottom line then, in terms of what you would suggest investors do here, is to essentially, more or less lean bullish as the market kind of sorts this all out?
Yeah, I mean, if you sold trading positions, and to me, Raymond James stock that I own is an investment position, but if you had, say, S&P indexes, and you sold them 2 weeks ago on that short-term sell signal, it's time to put some of that money back to work.
And just finally, I think you were looking at a potential target for the end of the year of S&P about 3,000. Do you think that's about where we go?
I think we're going above 3,000. How high we go above 3,000 is unknowable, but I think we'll be above $3,000 by the end of the year.
All right, Jeff, great to hear from you. Thank you very much for joining us today.
Always a pleasure, Michael.
All right, I'll see you. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.